Hi friends, good morning all. So we are in Advanced Accounting paper 5. So in this particular paper, Advanced Accounting, second chapter is Accounting for Advanced Issues in Partnership Books. So in this chapter, chapter 2, we have two units. Unit 1 is Dissolution of Partnership Firms, which already we have completed. The second unit in second chapter is Amalgamation of Partnership Firms. This unit deals with three topics. One is amalgamation of two partnership firms. So two transferor firms are there and one transferee firm will be there. Similar to amalgamation of companies, what we have discussed in fifth chapter. Then the next topic in this second unit is sale of a partnership firm to a company. And the third topic is conversion of a partnership firm into a company. So more or less second and third topics, that means sale and conversion, they go in same rhythm. That means they are almost same. And then comes amalgamation of partnership firms. This is also something similar to what we have learned in amalgamation of companies itself. Now, before we discuss anything, remember one thing. There are no accounting standards which govern specifically partnership issues. There are no legal provisions which govern accounting for partnership in some specific areas. That means, one, we do not have accounting standards for this. Two, we do not have statutory pronouncements for this. Statutory rules, regulations or provisions of Companies Act, provisions of Partnership Act, nothing. So generally this goes with regular traditional accounting. This goes with regular traditional accounting. So we'll see one by one. First what we do is we go to sale and conversion. Sale and conversion. After that we'll come to amalgamation. That will be easier way of learning. Okay. So shall we start with the problem? Along with problem I explain you the theory as well. Okay. So I believe, though there are so many folds to various problems here, I believe things are pretty simpler. So you really don't need to break your head and all. You need to understand the flow of the problem. Problem will have so many adjustments, so much of information will be given. So you should filter the information and your mind, you should be ready to, tabulate things which are given in description and all that kind of things you need to do. So now where shall we start? We can start with problem number 6. Yes, we can. Or we can start with the problem number 7 also we can, which is a big problem actually. Or we can start with problem number 8. Okay. So we'll start with problem number 8. Shall we start? And another thing is, whether you are doing new syllabus CA intermediate or old syllabus CA IPCC, there is no difference literally in this module. As it is same. Even the problems are same, the solutions are same, study material is same, theory is same, everything is same. So look at problem number 8. Okay, Prabhu and Company is a partnership firm consisting of Mr. Prabhu and Mr. Shiv, Mr. Bhola, who share profits and losses in the ratio 2:1. So Prabhu 2, Bhola 2 and Shiv 1. And Bhagavan Limited is a company doing similar business. So there is also a company by name Bhagavan Limited. Following is the balance sheet of the firm and that of company as on 31st March. So they have given on the liability side equity share capital, equity shares of rupees 10 each, Bhagavan Limited 10 lakhs they have given. Then partners capital account, Prabhu 1 lakh, Bhola 1,50,000, Shiv 50,000, general reserve 50,000 for this firm. And for Bhagavan Limited 3,50,000. Sundry creditors 1,50,000, 6,50,000. Then plant and machinery given 2,50,000, 8 lakhs. Furniture and fixtures 25,000, 1,12,500. Stock in trade 1 lakh and 4,25,000. There is some alignment problem. This stock in trade in this line, no, the amount is in the above line. Stock in trade 1 lakh. For the other company, stock in trade 4,25,000. Then debtors 1 lakh, 4,12,500. Cash at bank 5,000, 2 lakhs. Cash in hand 20,000, 50,000. So the balance sheet tallied with 5 lakhs and 20 lakhs. It was decided that the firm Prabhu and Company be dissolved and all the assets except cash in hand and cash at bank and all the liabilities of the firm be taken over by Bhagavan Limited by issuing 25,000 shares of 10 each at a premium of 2 rupees per share. Oh my god. Read this para. Read this para again. So tell me, what is total purchase consideration? Total purchase consideration is 25,000 shares issued at 12 rupees. 10 rupees capital, 2 rupees security premium, 12 rupees. So 25,000 into 12, 3 lakhs. Partners of Prabhu and Company agreed to divide the shares issued by Bhagavan Limited in the profit sharing ratio and bring necessary cash for settlement of their capital. So what is their profit sharing ratio? 2:2:1. So this 3 lakh rupees worth shares are there, no? They will be taking in 2:2:1 ratio. Okay. So first shall we prepare a working note for this? Problem number 8. We'll prepare one working note. Okay. Purchase consideration and apportionment of shares between partners. Okay. So total purchase consideration is equal to 25,000 shares into 12. That comes to 3 lakhs. Apportionment of shares, Mr. What are the names of partners? There are 3 people: Prabhu, Bola, Shiva. Two is to 1. So he will take out of 25,000 shares, he will take 10,000 shares into 12 rupees. So for him 1,20,000. So same for this guy also, and this guy will get 5,000 shares into 12 rupees each. That becomes 60,000. So total purchase consideration distributed in between partners like this, 3 lakhs. That's all. So this is working note 1. Calculation of purchase consideration, apportionment of equity shares of the transferee company between the partners. Okay. So look at it, read and try to understand it. Then we'll go to step 2. You're done? Then partners of Prabhu and Company agree to divide. This also we have done. Necessary cash, that will prepare partners capitals account. Then we'll understand how much of cash who has to bring. Then next one, the creditors of Prabhu and Company includes 50,000 payable to Bhagavan Limited. What to do? Transferor books, no effect. Transferee, intercompany indebtedness is to be cancelled. Creditor account debit to debtor account. Remember, as it is like your amalgamation. Amalgamation of companies is there, no? Same. We follow same. Then unrecorded liability of 12,500 of Prabhu and Company must also be taken over by Bhagavan Limited. Unrecorded liability. So when you are preparing realization account in the books of transferor, this will not come. Why? You have not recorded it. But the other company, when it is taking over assets and liabilities, they will record this 12,500 new liability. Okay. So this para will not affect the transferor books. This para will affect the transferee books. Then prepare realization account. Okay. Partners capital account. Okay. Cash and bank account in the books of Prabhu and Company. Okay. Then pass journal entries in the books of Bhagavan Limited for acquisition of Prabhu and Company. Pass journal entries in the books of Bhagavan Limited. Actually, second part is transferee accounting. First part is transferor accounting. Trust me, everything is similar to accounting for amalgamation of companies you have already learnt in chapter number 5. Same thing. Okay, so shall we start? We'll start with realization account. Any revaluations are there? No revaluations. So we'll start with realization account in the books of Prabhu and Company - Transferor. Okay, realization account, particulars rupees. So we write particulars rupees. Okay. So send all the assets and liabilities to revaluation. So plant and machinery account 2,50,000. So what is the journal entry? You remember, realization to assets. Simple. Even if you do not know anything in amalgamation for companies, imagine you are first doing this chapter. Close your eyes. Already I have an asset. Asset shows debit balance. Now I am selling away my business. This asset should be cancelled from my books. Already it is showing debit balance. To cancel, you need to credit it. So realization account debit to asset. When you are writing to asset is credited. Common sense. So we'll write two assets. So to plant and machinery 2,50,000. Next one, to furniture and fixtures 25,000. Next one, to stock in trade 1 lakh. Next one, to debtors 1 lakh. Unless otherwise specified, I would have taken cash at bank, cash in hand also. But in this question they said the transferee company has taken all the assets and liabilities other than cash in hand and cash at bank. So for this we need to prepare another ledger account. That we'll see. Don't worry. Okay. Now here creditors 1,50,000. So here by creditors. What is the logic? I am selling away my business. I need to cancel creditors. Creditors are showing credit balance in my books being liability. I need to cancel it, so I have to debit it. What is the journal entry? Creditor account debit to realization account. So in realization by creditor. That's all. Then general reserve partners capital you cannot transfer to realization. That is to be transferred to partners capital accounts. That's it. By purchase consideration. Bhagavan Limited. So this is, what is this? This is purchase consideration. How much? 3 lakhs. Already we have prepared one working notes for this. Correct? Anything pending? No. So look here. What is the total? 4,50,000. Now check here 4,75,000. So bring 4,75,000 here also. Then 25,000 is the loss by realization loss. Okay, to Mr. Prabhu. What are the names of these guys? 3 guys are there. Prabhu, Bhola, Shiva. Prabhu, Bhola, Shiva. 3 people are there. Okay, so Prabhu has to take 10,000 loss. Shiva has to take 10,000 loss. Sorry, Bhola has to take 10,000 loss. Shiva has to take 5,000 loss. Why? 2:1. Total realization loss is 25,000. No, that 25,000 loss should be apportioned between partners in their profit sharing ratio. How? 2:1. 25,000 into 2 by 5. 10,000. Bhola 25,000 into 2 by 5. 10,000. Shiva 25,000 into 1 by 5. 5,000. So with this, realization account is over. You understand realization account? Easy, no? So next step will be cash. So we'll prepare cash account. And what do we do next? Next we will prepare partners capitals account. We'll prepare partners capital account. So how many are there? Particulars. Okay, and then we have Prabhu, Bhola, Shiva. Again we write particulars, Prabhu, Bhola, Shiva. Okay, these are the accounts we are going to prepare. Partners capital account. Shall we start? Okay, now cash account will start with opening balance. Cash in hand, cash at bank, both put together same account. So 20,000 plus 5,000, 25,000 to balance. Brought forward 25,000. Now bring opening balances in partner capital also. यहाँ देखो partners capitals में 1 lakh, 1,50,000, 50,000. So by balance. Partners capital shows credit balance, no? How much? 100, 150, 50. 100, 150, 50. Okay, then reserves 50,000. The reserves also belongs to partners only, no? So general reserve you call it, P&L you call it, that also belongs to partners. So this 50,000 also should be given to all the three partners in their 2:1 ratio. 50,000 in 2:1 ratio. So how much? First guy will get 20,000 reserves, second guy will get 20,000 reserves, third guy will get 10,000 reserves. So by reserves 20,000, 20,000, 10,000. Next, do you remember our working note 1? Oh my god, what is that? Shares to be given to partners. Do you remember our realization account? In realization account there is loss. So to realization loss. How much? 10,000, 10,000, 5,000. And then by purchase consideration. Purchase consideration means shares in Bhagwan Limited. How much? Do you remember here? We have already written this 1,20,000, 1,20,000, 60,000. So we'll write 1,20,000, 1,20,000. No. This is on the other side. We need to write. It reduces capital. No, it is withdrawal to purchase consideration. Or you can write shares in Bhagwan. This is purchase consideration. Okay, shares in Bhagwan, this is purchase consideration. So how much we are giving? For P we are giving 1,20,000. For B we are giving 1,20,000. For S we are giving 60,000. Now you need to settle the balances. Now do you remember what they said in the problem? In the problem they said all the partners agreed to take shares in the new company in their profit sharing ratio. If at all anyone has to bring cash, they will bring in cash. If at all any person capital account has a surplus, they will withdraw that cash. So now look here, P has a credit balance of 1,20,000. Okay, when you add all the credits, P has a credit balance of 1,20,000. But his debits are 1,30,000. So 1,30,000. What to do? Close your eyes. LKG accounting. He has to bring 10,000 rupees of cash. Okay, so here we write by cash. Okay, in cash account we write to Mr. P. To Mr. P. How much will write? 10,000. Mr. P is bringing 10,000. Now look at B account. Debits 130, credits 170. Oh. So 170 credit, 130 debit. So 40,000 excess, he will take it in cash. So to cash. To cash. In cash account by B 40,000. Then look at the third guy. Debits 65,000, credit 60,000 only. So 65,000. Here he will bring 5,000. So simple. Firm has to give firm has to give 60,000 to you, but firm, wait, see, these are the credits, so you are eligible for 60,000, but you are losing 5,000, so now only 55,000 will come to you, but still you are getting 60,000 worth shares. That means you have to bring 5,000 now. Equation tallied. So you have two ways of understanding this. Prepare partner's capital account and cash account. Wherever partner capital account shows deficit, he will bring cash. Wherever partner capital account shows surplus, he will withdraw cash. That's all. So this guy will bring 5,000 cash. So to Mr. Yes, 5,000 cash. Now the control for you is cash account should tally without a balance. Cash account should tally without a balance. So check karo yahan. So this side 40,000 and this side also 40,000. Cash tallied, capital account tallied, realization over, accounting in the books of transferor is done. This is capital account. This is cash account. So you understand this? Just have a look at all the numbers. Okay, simple. From the opening balance sheet of the firm, whatever is given in the question, all assets and liabilities transferred to realization account. Partners' capitals and reserves transferred to partners' capital account. That's all. And then you have written purchase consideration, discharge of purchase consideration, tallied. That's it. LKG problem. Okay. Now the second part is accounting for this amalgamation in the books of the transferee company Bhagavan Limited. Shall we do that? Okay, so part 2. Accounting in the books of Bhagavan Limited. Who is this guy? Transferee. That means buying company. Particulars, debit, credit, journal entries. We need to write only journal entry. Do you remember what is the first journal entry? Same like that amalgamation. Business purchase account debit to liquidator of transferor. Who's transferor here? Prabhu and company. How much? 3 lakhs. So what is the narration, right? You write being purchase of business from Prabhu and company. Being purchase of business from Prabhu and company at an agreed purchase consideration of 25,000 shares of rupees 10 each, issued at a premium of rupees 2. That's it. Then what is the second entry? Incorporation of assets and liabilities. All assets account debit, all liabilities account debit. Then record purchase consideration. Then tally debits and credits. If the balance is coming in the debit side deficit, you will write goodwill. If the balance is coming on the credits side, you will write capital reserve. Same accounting. So I strongly recommend you, before doing this, at least do one problem of amalgamation. Go to 5th chapter, amalgamation. One problem which covers exhaustively all the journal entries, all the transactions. Do one problem and then come. It is a football cakewalk for you. Very easily you will be able to do it. You understand? Then assets. What are the assets taken over? Plant and machinery 2,50,000. Furniture and fixtures 25,000. Then stock in trade 1 lakh. Then debtors 1 lakh. Give 1 line gap. If at all goodwill comes, we need to write. Then to sundry creditors 1,50,000. Anything else? Unrecorded liability to other. In brackets I am writing unrecorded liability 12,500. To purchase consideration. To business purchase. Purchase consideration 3 lakhs. Okay. Now take a calculator, add all these numbers. 2,50,000 plus 25, 2,75,000, 3,75,000, 4,75,000. That side 4,75,000. So take 4,75,000 minus 3 lakhs, 450, 462, 500. 12,500 is the balance. This side 12,500 is the balance. So what will this be? To capital reserve, balancing figure. Now add both the sides, 4,75,000, 4,75,000. That's it. So do you find any difference between accounting in the books of transfer or transferee in case of partnerships, in case of companies? No, it is absolutely same. You understand the second journal entry? Third journal entry being assets and liabilities are taken over, purchase consideration recorded, and the balance is recognized as capital reserve. This is second journal entry. Third journal entry would be discharge of PC. Liquidator of Prabhu and Company. In first journal entry you have recorded 3 lakhs, no? How you are paying? To equity share capital. Hold on, my dear friends, 25,000 shares into right face value only in share capital account. Balance should be security premium, no? To security premium. To security premium. How much? 25,000 into 2 rupees. 50,000. Being discharge of purchase consideration by issue of equity shares. That's it. Accounting is over. No. Intercompany indebtedness is there. 50,000 rupees, one entity has to pay to another entity, no? Whether transferor has to pay to transferee, transferee has to pay to transferor, accounting is same. Cancel creditor, cancel debtor. So you will write creditors account debit to debtors account. How much? 50,000? 50,000. Being cancellation of intercompany owings in the process of amalgamation. That's all. 4 journal entries. The problem is over. Don't you think this is a simple problem? Okay. So in this problem what we have done? Accounting for amalgamation in the books of Transferor, that is Prabhu and Company, wherein we have prepared realization account, we have prepared capital accounts, we have prepared cash and bank. Then accounting for amalgamation in the books of Transferee Company, which is Bhagavan Limited. In that we have written 4 journal entries. First one is business acquisition entry, second one is assets and liabilities taken over entry, third one is purchase consideration discharge entry, fourth one is intercompany indebtedness cancellation entry. As it is same like your 5th chapter. Okay, any doubts on this? So shall we go to next problem? So we'll see next problem.